Stop watching the aircraft carriers. Right now, while you're distracted by military parades in the Taiwan Strait, China is executing the largest financial evacuation in modern history. $688 billion. That's how much American debt Beijing has left, and they're selling it at a loss. When the world's second-largest economy voluntarily loses billions just to exit your bonds, that's not portfolio management. That's preparation for war. And what I'm about to show you from the latest Treasury data will change how you see everything. I'm Robert, and this is what happened after. Forget what the mainstream financial media is telling you. This week's Treasury International Capital Report, the TIC data, reveals something Wall Street has been desperately trying to bury for 12 months. China's holdings of U.S. Treasury bonds have crashed to $688 billion as of October 2025. Now, to most people, that sounds like a fortune. But here's what they're not telling you. This is the lowest level since May 2009. We've just erased 16 years of financial integration in less than 2 years. Let me put this in perspective. Back in 2013, at the peak of what economists called Chimerica, that beautiful symbiotic relationship where China made stuff and America bought it, Beijing held $1.32 trillion in U.S. debt. They were funding the American deficit. They were the buyer that kept interest rates low and kept the whole machine running. That loop is shattered. China has liquidated nearly 48% of their position. They've dumped over $600 billion worth of American IOUs onto the market. But here's where it gets disturbing. Throughout late 2024 and all of 2025, the U.S. bond market has been in historic turmoil. Interest rates volatile, bond prices depressed. Anyone selling treasuries during this window was selling at a realized loss. And in asset management, you never, and I mean never, sell a depreciated asset for a loss unless one of two things is true. You're facing a liquidity crisis and need cash immediately, or you believe the asset is about to become toxic. China isn't broke. Despite their real estate disaster, they're still running massive trade surpluses. They're swimming in dollars. So there's only one conclusion that fits the data. The Chinese Communist Party has decided that U.S. Treasury bonds are no longer a store of value. They're a strategic liability. And they're getting out before it's too late. But if China is dumping hundreds of billions and the market hasn't collapsed yet, someone else must be buying. And when you see who's absorbing this debt, you'll understand why the next financial crisis is already baked into the system. Stay with me. To understand what's really happening, we need to go back to February 2022. When Russia invaded Ukraine, the United States and European Union executed a financial strike that sent shockwaves through Beijing. Overnight, they froze $300 billion of Russian central bank reserves. Money sitting in accounts in New York, London, Brussels, money Russia thought was untouchable, was seized with a few keystrokes. Beijing watched this very carefully. They analyzed every detail. And they realized something terrifying. If they make a move on Taiwan, if the South China Sea goes hot, their $688 billion in U.S. Treasuries isn't an asset. It's a hostage. The moment Washington applies sanctions, that money evaporates. It goes to zero. So they're liquidating. They're willing to take a 10% or 20% haircut on the face value today rather than risk a 100% loss tomorrow. This is what strategic liquidation looks like. It's the financial equivalent of a burn notice. They're dismantling the wall of debt that stabilized the U.S. economy for 2 decades, and they're doing it with urgency. Usually, central banks hide their selling to avoid spooking markets. They sell slowly, in small chunks. But the velocity here, shedding nearly $12 billion in October alone, tells us Beijing is less concerned with market stability and more concerned with capital flight. They want the money out of U.S. jurisdiction, and they want it out now. This has massive implications. For 20 years, the U.S. government could run trillion-dollar deficits because there was always a buyer in the East. China would buy the debt regardless of yield because they needed to recycle their trade surplus. That buyer is gone. China has turned from the biggest buyer into the biggest seller. So who's going to fund the U.S. deficit now? The answer is disturbing. America's allies are being forced to step in, and they're cannibalizing their own economies to do it. But this strategy has a fatal flaw that could trigger the collapse everyone fears. Let me show you the data. When the second largest holder of your debt dumps hundreds of billions onto the open market, basic economics says prices should crash. When supply floods in and demand vanishes, prices fall. In the bond world, when prices fall, interest rates skyrocket. If market forces were allowed to work naturally, China's exit should have pushed 10-year Treasury yields significantly higher. That would be catastrophic, exploding mortgage rates, bankrupting regional banks, making interest payments on the national debt unsustainable. But curiously, that hasn't happened yet. Rates have risen, yes, but the market hasn't collapsed.
Why?
Because as China steps out, the allies are being forced to step in. Look at the TIC data closely. While China's line item is plummeting toward $600 billion, other line items are spiking to historically abnormal levels. The United Kingdom's holdings have surged to record highs, over $750 billion in late 2025. That puts the UK neck and neck with China as the second largest foreign creditor to the United States after Japan. Think about that. The UK economy is 1/6 the size of China's. Britain doesn't run a massive trade surplus, they run a deficit. So where is Britain getting $750 billion to buy US debt? They're not buying it with excess profits like China did. They're buying it with borrowed money, through financial engineering in the City of London. The UK is leveraging its own balance sheet to act as a shock absorber for the US Treasury market. Then there's Belgium. Their holdings are roughly $320 to $370 billion. Is Belgium suddenly flush with cash?
No.
Belgium is home to Euroclear, one of the world's largest securities depositories. When you see Belgium buying US debt in the TIC report, it's rarely the Belgian government. It's a proxy, other central banks, sovereign wealth funds, custodial accounts trying to mask their activity. It creates anonymity. The surge in UK and Belgian holdings occurring exactly as China sells suggests a coordinated effort by the G7 nations. This is what I call the bag holder alliance. This isn't a free market decision. Why would a rational investor in London or Brussels aggressively buy US Treasuries right now? The US is running a $2 trillion deficit, inflation is sticky, the currency is being weaponized. Buying US debt right now is objectively risky. The fact that allies are loading up suggests geopolitical arm twisting. Washington is effectively saying, if you don't absorb what China is dumping, the US bond market breaks. If the US bond market breaks, the global financial system breaks, and we can't protect you. It's financial conscription. The West is cannibalizing its own balance sheets to absorb Beijing's supply. But this strategy has a fatal flaw: capacity. China had seemingly infinite capacity to buy debt because they were the factory of the world, earning real dollars by selling real goods. The UK and Europe don't have that capacity. They're already struggling with their own debt burdens, slow growth, and energy transitions. By forcing them to buy US Treasuries, Washington is draining liquidity from its own allies, weakening the periphery to save the core. But here's what's really chilling. While the West shuffles paper liabilities among themselves, China is taking the cash and running, converting every dollar into something the US Treasury can never touch. And what they're buying reveals their exact timeline for conflict. When China sells a US Treasury bond, the transaction settles in US dollars. The People's Bank of China receives digital credits in a custodial account. But China doesn't want dollars. Dollars are traceable, sanctionable, subject to inflation. So what are they doing with the proceeds of this $700 billion exit? They're not buying euros, which are just dollar vassals. They're not buying Japanese yen. They're engaging in the most aggressive commodity accumulation drive in modern history. They're converting paper claims into physical reality. While Western analysts stare at stock tickers, Chinese state-owned enterprises are swallowing record amounts of raw materials. This isn't commercial inventory. This is strategic hoarding for war. First, gold. The ultimate anti-dollar. The People's Bank of China has been a relentless buyer for 18+ consecutive months officially. Unofficially, based on Shanghai Gold Exchange withdrawals, the buying is far larger. They're using dollars from bond sales to buy metal on London and Swiss markets and shipping it east. Gold has no counterparty risk. It cannot be frozen by the SWIFT system. By swapping US debt for gold, China is moving from credit-based reserves to collateral-based reserves. Second, oil. China imports 70% of its oil. This is their strategic Achilles heel. In a conflict, the US Navy could blockade the Strait of Malacca and starve the Chinese economy of energy. To counter this, China has been buying record amounts of oil from sanctioned nations like Iran and Russia, paying in yuan and bypassing the dollar entirely. But crucially, they're filling their strategic petroleum reserves to capacity. Recent data indicates China's crude stockpiles are nearing 1.5 billion barrels. Satellite imagery shows construction of massive new storage farms and underground caverns. They're building a buffer to survive a naval blockade for months, perhaps years. Third, copper and strategic minerals. This is the most telling signal. China's property sector, historically the biggest consumer of copper, is in depression. Real estate starts are down. Yet China's imports of copper ore remain near all-time highs, roughly 28 million tons in 2024. This defies economic logic. If you're not building apartments, why do you need so much copper? Because you're shifting to a war economy. You need copper for energy grids, munitions, drones, electric vehicles. China is cornering the market on the physical inputs of 21st-century warfare. They're also hoarding cobalt, lithium, and rare earths. Fourth, food. China produces 20% of world GDP but has only 7% of the world's arable land. According to the USDA, China holds approximately 60 to 70% of global reserves of corn and wheat. They have enough grain to feed their population for over a year without a single import. They're trading bond yields for survival calories. This is the fundamental shift. A nation that plans for peace keeps wealth in efficient interest-bearing instruments. A nation preparing for conflict converts wealth into inefficient physical stockpiles. Holding copper pays no interest, it costs money to store, and has negative yield. But it has a massive return on survival. This explains the loss they're taking on bonds. Western economists mock China. They sold at the bottom, realized billions in losses. This is short-term thinking. Beijing doesn't care about mark-to-market losses in fiat terms. If they sell a bond at an 80% loss but use proceeds to buy oil they'll desperately need if Malacca is closed, that's a winning trade. They're trading fake wealth that can be frozen for real wealth that can be burned in an engine or fired from a barrel. So the question isn't whether China is preparing for conflict. The data proves they are. The real question is, how do you protect yourself when the world's safest asset, the U.S. Treasury bond, becomes a battlefield? I'll give you 3 protocols that could save your portfolio. For 40 years, the 60-40 portfolio, 60% stocks, 40% bonds, was the gold standard. Bonds were the safe haven, the ballast keeping the ship steady. That era is over. The U.S. Treasury bond is no longer risk-free. It's a political football in a global economic war, an asset class that relies on the kindness of strangers who are increasingly becoming enemies. If China, the ultimate insider of global manufacturing, is getting out, you need to ask yourself, why are you staying in? Here's how you position yourself for this new reality. Protocol 1. Shorten your duration. Duration measures how sensitive a bond's price is to interest rate changes. Long-term bonds, 20-year, 30-year treasuries, have high duration. If interest rates rise 1%, a 30-year bond can crash 20%. As China exits, structural pressure on long-term rates is upward. Even if the Fed cuts short-term rates, the long end of the curve, determined by supply and demand, not the Fed, is vulnerable to a buyer's strike. If China sells and the UK taps out, yields must rise to attract new buyers. Rising yields mean crashing prices for existing bondholders. Do not hold long-term U.S. government bond ETFs like TLT. These are the most vulnerable assets to Chinese selling. If you want safety and yield, keep cash in short-term T-bills, 1 to 6 months. Short-term bills have almost zero duration risk. They act as cash equivalents. Be like China. Get liquid, get short-term. Don't lock your money up for 30 years with a government fighting an economic war. Protocol 2. Follow the smart money into commodities. China is selling paper to buy stuff. You should consider doing the same. Your portfolio needs exposure to energy, metals, and real assets. This isn't just about profit, it's inflation protection. Think about the endgame. If China dumps $688 billion and allies eventually stop buying, who buys the debt? The Federal Reserve. The Fed will have to step in as a buyer of last resort, implementing yield curve control. They'll print trillions to monetize the debt. When they print trillions, the dollar's value falls and prices rise. This is the inflationary loop China understands. Own producers of these assets. If China is hoarding copper, own the miners, companies like Freeport-McMoRan or Southern Copper. If China is hoarding oil, own energy producers like Exxon or Chevron. If China is hoarding gold, own the metal. These assets hedge against currency debasement. Own the stuff, not the currency that buys the stuff. Protocol 3. Watch the allies. You need warning signals. You need to know when the bag holder alliance is breaking. Monitor currencies of key U.S. allies, specifically the British pound and Japanese yen. These countries are straining resources to support the dollar bond market. Japan is the largest holder of U.S. debt but is fighting a currency crisis. The yen has been volatile. If Japan has to intervene to save the yen, they'll sell U.S. Treasuries to get cash to buy their own currency. If Japan joins China in selling, it's game over for low rates. Watch the U.S. dollar to Japanese yen exchange rate. If the yen crashes toward 160 or 170, or if Japanese bond yields spike, the bag holder alliance is fracturing. That's when the Federal Reserve will be forced to intervene, not because inflation is beaten, but because the Treasury market is broken. The $688 billion figure isn't just a statistic in a government report. It's a countdown clock. China is methodically, deliberately removing itself from the U.S. financial system. They're clearing the decks. They're willing to take losses today to ensure survival tomorrow. Don't interpret current market stability as safety. It's artificial stability propped up by political pressure and borrowed money. When that prop gives way, the adjustment will be violent. Get out of long-term debt. Get into hard assets. Watch the flows. The divorce is finalized. We're just waiting for the house to be sold. If this analysis opened your eyes to what's really happening behind the headlines, subscribe to What Happened After. We dive deep into the data the mainstream ignores, reading the footnotes while others skim headlines. Hit that like button, share this with anyone who needs to understand what's coming, and drop a comment with your thoughts on China's exit strategy. The protocol is active. What happened after has your back.